At 1 minute past 8 on the morning of August 1st, 2012, an automated email arrived in the inboxes of a group of employees at Knight Capital, the largest trader of American stocks. It flagged an order routing system, and it contained an odd phrase, "Power peg disabled." Nobody acted on it. 56 seconds later, another one arrived, then another. By the time the New York Stock Exchange rang its opening bell at 9:30, the system had sent 97 of them, patiently, to people who did not understand they were reading a warning. 89 minutes of notice. Then the bell rang, and Knight Capital began to destroy itself at the speed of light. What happened next took 45 minutes. It has been retold for years as a fable about a single line of bad code, a typo that killed a company. The government's own autopsy, an order from the Securities and Exchange Commission, tells a different and far more unsettling story. The new code worked. On 7 of Knight's 8 servers, it worked perfectly. This is the story of the 8th server, and of a morning when a firm watched itself bleed at a rate no human being was fast enough to stop. To understand it, you have to slow the clock down until 45 minutes becomes visible. Start with the firm. Knight Capital was the plumbing of the retail stock market. When ordinary Americans clicked buy in their brokerage accounts at TD Ameritrade, at E-Trade, the order very often went to Knight, whose machines executed it in fractions of a second. On a normal day, Knight traded billions of shares. Its chief executive, Thomas Joyce, a Harvard hockey player turned trading executive known on Wall Street as TJ, liked to say the firm stood for the little guy's order, getting a fair shake. In the summer of 2012, the exchange was launching a new program for exactly those retail orders, and Knight had 1 week to write and install the software to join it. Inside Knight's order routing system, there was a ghost. Years earlier, the firm had used a piece of test software called PowerPeg, code whose entire purpose was to buy high and sell low, deliberately, to push prices around in test environments and prove other systems worked. Knight had stopped using PowerPeg in 2003, but it was never deleted. It sat in the routing system, dormant, for 9 years. In 2005, engineers moved the safety counter that told PowerPeg when to stop, and never retested the dead code they were sure would never run again. All that stood between the market and a program designed to lose money on purpose was a single software flag, switched off. For the new program, Knight's engineers wrote fresh code, and they made one fateful economy. They reused that flag. During the last week of July, a technician rolled the new software out to the 8 routing servers, one, by hand. 7 got it. The 8th did not. The SEC's order states the failure with terrible simplicity. Knight did not have a second technician review this deployment, and no one at Knight realized that the PowerPeg code had not been removed from the 8th server. There was no written procedure requiring anyone to double-check. On 7 servers, the flag now meant route retail orders. On the 8th, it still meant what it had meant in 2003, buy high, sell low, as fast as possible, forever. On July 31st, the day before the program went live, Thomas Joyce had knee surgery. He spent that night at home, with his leg elevated, planning to dial into the launch from his couch. The launch, everyone assumed, was routine. The code had been tested. The exchange had approved the program. The morning of August 1st was expected to be a footnote, which brings us back to 1 minute past 8. As Knight's systems warmed up for the day, the 8th server began processing test messages, and something deep in the routing system noticed a mismatch and started to complain. By email, PowerPeg disabled. The SEC would later note that these messages were not designed as system alerts. and no one was assigned to act on them, so no one did. 97 warnings, one every 56 seconds, for 89 minutes, each one naming the exact ghost that was about to wake up. It was the cheapest chance anyone would get all morning, and it cost nothing to ignore. At 9:30, the market opened, and 212 small retail orders flowed into Knight's routing system. 7 servers handled their share correctly. The 8th handed its orders to PowerPeg. The dead code did exactly what it had been built to do 9 years earlier. It began buying high and selling low, at machine speed, with no memory of ever having filled an order. The SEC's language is precise. The server continuously sent child orders in rapid sequence for each incoming parent order, without regard to the number of executions Knight had already received. One part of Knight's system knew the orders were filled. That information was not communicated to the routing system. The loop had no exit. Slow the clock down, and here is 1 minute of August 1st. In the stock of one utility company, Exelon, the machine was buying at the offer and selling at the bid, losing roughly 15 cents on every round trip. It completed that circuit about 40 times a second, 2,400 times a minute. On the floor of the exchange, the humans could feel it before they could name it. By 9:31, a television reporter standing there would recall, people were already saying, something is wrong. By 9:35, people were yelling. Millions of orders went out. 4 million trades printed. 397 million shares changed hands. Knight was accidentally accumulating one of the largest unintended stock portfolios ever assembled, at a pace of roughly $150 million a minute. Inside Knight, engineers scrambled through the fog with no map. The SEC found that on August 1st, Knight did not have supervisory procedures concerning incident response. No checklist, no drill, no procedure to halt the routing system in response to its own aberrant behavior. The exchange called Knight several times, but the firm was reluctant to hit its kill switch, because that would shut off every customer's trading, not just the poisoned flow. And then, at the heart of the 45 minutes, comes the sentence that should be taught in every engineering school. In one of its attempts to address the problem, Knight uninstalled the new code from the 7 servers where it had been deployed correctly. This action worsened the problem. The cure spread the disease. Now all 8 servers were feeding orders to a program designed to lose money. They had diagnosed the new code when the killer was the old one. By about 10:15, the flow was finally stopped. In 45 minutes, Knight had bought roughly $3.5 billion of stock it did not want, in 80 names, and sold short another $3.15 billion in 74 more. An unintended portfolio of $6.65 billion. 37 stocks had been driven more than 10% from their opening price. And here is the cruelest arithmetic of the morning. The exchange reviewed the damage and canceled trades in only 6 securities. Every other trade stood. The market had a rule for busting clearly erroneous trades, and Knight's trades, executed one small order at a time, at prices that moved gradually, mostly did not qualify. The mistake was legally binding. Knight spent the next day trading its way out of a portfolio it had never meant to own, and the escape crystallized the loss, over $460 million, about 4 times what the firm had earned the entire previous year. Thomas Joyce's wife drove him to the office one day after knee surgery, and he stayed for the better part of 5 days. On television, on crutches, he did not hide. It was a software bug, he said. It happened to be a very large software bug. And later, more plainly, we screwed up. we paid the price. The most important thing is we got our clients out of the way. What followed was a rescue measured in hours. Knight needed roughly $400 million before Monday's open, or it would not open at all. Through the weekend, Joyce and his team called, by his own estimate, in the neighborhood of 90 parties. The investment bank, Jefferies, conceived and structured the deal. $400 million in convertible preferred stock at $1.50 a share. The price of survival was the company itself. The new investors could end up owning about 3/4 of it. A television anchor put it to Joyce without mercy. You just sold control of the company for $1.50 a share, and we didn't get a chance to vote. Knight opened on Monday. It was, Joyce said later, one of the most successful financial services rescues ever, and he was probably right, and it did not save him. Within 5 months, Knight agreed to merge with Getco, the high-speed trading firm that had been one of its rescuers. Joyce left with a retention payment and no company. The Securities and Exchange Commission fined Knight $12 million, the first enforcement action ever brought under the market access rule, and wrote the epitaph in a single official sentence. Knight Capital's failure to ask these questions had catastrophic consequences, and the technician who deployed the code to 7 servers instead of 8 was never publicly named. The SEC charged no individual. Read the order closely and you see why. It is not the story of a person who made an error. It is the story of a firm that built no net to catch one. Because here is what the 45 minutes actually prove. The fatal decisions were all made years before the morning. Dead code left in a live system. A safety flag reused to mean something new. A deployment with no second set of eyes. No written procedure. No automated check that 8 servers matched. 97 warnings routed to inboxes instead of alarms. Any one of them fixed, and August 1st is a footnote. The SEC said it in one line. A simple double check of the deployment could have averted the events of August 1st. The machines were never the danger. The danger was everything the humans didn't build around them. The SEC signed its order in October of 2013, but the Postmortem writes itself. The only question is whether anyone reads it before the next one.